Hello and welcome back to All Things Money. I'm your host, David Blain. During this segment, we're going to continue our discussion on the economy, how the economy works, hopefully in very simple terms, so we can put everything that's going on, this recession, the debt crisis, what's going on in Europe, help you kind of give it in a framework that's simple to understand. If you missed last week's show or other segments today, head on over to the website, www.dlblain.com. That's DLBLAIN.com. And you can catch up there on the shows that you missed. But we're talking about the economy and how spending money comes from both actual physical dollars, and in the modern world, it's money issued by some sort of central bank, whether it be dollars or euros or yen or won, whatever, or credit, which is simply the promise to pay. Now, all economic activity and financial market prices are due to a change in money or credit and the total quantity sold. And so this is what I want you to remember from this. I talked about this last show. The change in total economic activity, the larger portion of change in economic activity is due to the change in total money that is available. And remember, money is both cash as well as credit. And that's simply because it's easier to change the amount of money out there than it is to change very rapidly the supply. And so because money and credit are easier to create, the federal or the U.S. Treasury can just print more money, or the banks can just out of thin air create credit. And because credit and money are easier to create than the goods or services that you actually purchase with that, you have economic cycles. So that's the key thing to remember, is that the creation of money and credit is what causes these cycles. Now, in the capitalist system, we buy and sell goods and services using money and credit, and it's a free choice to pursue our own interests. The production and purchases of financial assets, lending and industry is what we call the capital formation. You have capital providers, which are the investors and lenders that put money into the production of financial assets and form capital. It could be either investing in the stock of a company that is producing something, or it could be loaning money for the purchase of a new factory or new service business or something like that. So that's the capital providers are the investors and the lenders. The capital recipients are your both borrowers, people that are borrowing money, your entrepreneurs taking in a loan, or the sellers of equity. I'm going to sell part of my company to this investor for some money, and I'm going to take that money and invest it in the means of production. Okay, so that's kind of the capitalist system in a nutshell. As you have this whole capital formation is a free choice between people with capital and people that want capital, the borrowers, lenders, investors, and sellers of equity. So you have these groups here that through the free market can engage in the capital formation process. Now, the central bank controls the total money, the total number of dollars in existence, and they do that one way is by the reserve requirements of the banks and printing of money and that sort of thing. But credit can be created out of thin air. And this is key to remember, is that any two parties can agree to create credit. As I mentioned in the last segment, say you've got a mower and you've hired a lawn service now, and you don't need that lawnmower, and a new person moves in next door. They used to live in an apartment. They need a mower, and because they just moved in, they don't have any money, and they say, well, can I buy your lawnmower from you? And you say, sure. And they say, well, I don't have any money. Can I pay you in 6 months? You have just created credit, and it's no more basic than that. So credit can be created out of thin air. And it's because of the fact that credit can be created out of thin air that you have the occurrence of bubbles. You have these cycles. And bubbles occur when the credit created, you have more credit created than can be paid back. It's as simple as that. Is you have a bubble in real estate when you have more credit in the real estate industry than it can ever be paid back. You have a bubble in financial assets such as the tech boom in the early 2000s. You have more people borrowing to invest into stocks and things like that than can ever be paid back. And so you have these bubbles. Now, let's kind of get into when capital contractions occur, when the amount of money, either the number of dollars or credit shrinks, you have economic contractions, where there's not enough money and or credit spent on goods, services, and financial assets. So in contrast to a bubble where you have way more credit that can ever be paid back, you have economic contractions when there's not enough money or credit spent on things. And so this is usually what happens. You have a bubble and it gets burst, and now you don't have enough money out there. Okay, so these capital contractions take really two forms. Number one is what most people are familiar with, a recession. And recessions are contractions within what we call a short-term debt cycle. And then we have depressions, which are contractions that take place with deleveraging. And recessions are more typically understood because they happen most often and people have experience with them, whereas depressions and deleveragings are really pretty poorly understood because they don't happen very often. I know Ben Bernanke, one of his things when he came in, that he did a lot of studying for the Great Depression and the cause of the Great Depression and the things that were done right and the things that were done wrong. And it's just simply because they don't occur very often that people are generally not familiar with the long-term deleveraging cycle known as a depression. Okay, so that's kind of what we're going to focus on here. We just have a little bit more time left today, and we'll pick this up again next week, but we're going to focus really on these two cycles, the short-term cycle of the business cycle, where the rate of growth in spending is faster than the rate of growth in the capacity to produce. So you have money growing faster than the rate that you can produce, and so what happens is that prices go up until the rate of growth in spending is curtailed by the expansion of credit, and then a recession occurs. And so a recession, in simple words, is an economic contraction that is due to contraction in private sector debt growth arising from tight central bank policy, which ends when the central bank eases its policy. Well, I know that's a big mouthful, but we're going to dissect that more for you next week. So we hope you'll join us again at the same time, the same stations next week. For All Things Money, I'm David Blain.
The proceeding was a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media.